Hello and welcome to today's webinar. We have a great presentation lined up for you today, but before we get started, there are just a few general admin points to cover. First and foremost, please use the online question tool to post any questions that you have, and we will share them with our speakers. Second, if you experience any technical difficulties today, please let us know in that same question tool and we will do our best to resolve them. And finally, just to note, the recording of this session will be shared via email in the coming days. So, without further ado, I'd like to hand over to our speakers.
Thank you very much, and good afternoon, good morning, good evening, everyone. Today's session is titled Bringing Crypto into the Mainstream, Why Crypto Asset Regulation Matters. So I'm Monica Saw. I'm a financials regulatory partner at Clifford Chance in the London office. And I'm joined today by an expert group of senior Clifford Chance lawyers from across the globe, representing all major geographic regions. So from APAC, we've got Rocky Mew, who's a fintech partner in Hong Kong. From the US, we have David Adams, an SEC regulatory counsel from our Washington office. From continental Europe, we have Ricardo Cosin, who is regulatory counsel in our Milan office. And last but not least, of course, we have Laura Douglas in UK, who's a senior associate in the financial regulation group with me in London. Okay, so this cross-jurisdictional panel will give you a flavor of where international regulators are in keeping up with the dynamic, fast-changing world of crypto assets. So we are experiencing in live play the volatile evolution of crypto markets from the BTC highs we saw last year to the winter lows, and regulators and policymakers globally are grappling with how to respond with the risks and opportunity of the marketplace. So in this session, we'll discuss how crypto asset regulation and supervisory approaches are developing in the UK, EU, US, and APAC, and then consider the importance of regulation in underpinning the mainstream adoption of crypto assets by financial investors, banks, and other traditional financial market participants. So I have two very high-level observations on the global sort of regulatory framework. First, there is no global international harmonization of regulatory frameworks. So this lack of consistency across different jurisdictions creates a global patchwork of regulatory frameworks. And so the risk for crypto firms and institutions is that they need to navigate each country individually, and thereby creating problems in or risks in relation to launching and providing services in a very borderless product sector. The second observation I have is that where you do see a regulatory framework in local jurisdictions, the local approaches are very different. On one hand, you have some regulatory regimes which are aiming to run fast and put in place a regulatory framework creating certainty. So for example, we'll talk later on about the EU and the new regime which are being proposed in the EU, but which from a substantive point of view have very securities-like regulatory concepts and structures. So the substance, question mark, may be more stringent for the market evolution as opposed to other regulatory frameworks. On the other hand, we've got other local regimes or other regulators who don't want to move too fast in introducing regulatory frameworks and risk stifling the growth and innovation of crypto markets. So, for example, in the UK. But that said, the risk here is that uncertainty creates risk. It doesn't create necessary opportunity. It creates risks from financial investors and institutions particularly. And so by that risk of lack of certainty, this hinders the development of the market evolution. So in this context, we're going to cover three major themes. The first is, what are the major regulatory developments and supervisory approaches across the different jurisdictions, and what are some of the challenges that firms need to respond to? The second theme is about launching crypto products themselves. What are some of the legal and regulatory considerations. Does the regulatory approach impact positively or negatively on issuers and investors in crypto assets? And the third theme is about crypto asset service providers, including custodians, exchanges, prime brokers. What do service providers need to focus on? So we're going to kick off with a poll on the audience's impression of the trajectory of regulatory frameworks in the key geographies. So I'm just waiting for the poll to pop up. Here we go. So in your view, which crypto asset regulatory framework strikes the right balance between protecting customers on one hand and promoting innovation in crypto markets on the other? So we've got 5 jurisdictions. If people can vote, that would be great. So you should be voting for either US, UK, EU, Hong Kong, Singapore. It's very interesting. We have a tie between EU and Singapore, and the UK is behind that at 23%, and then US is second last, and unfortunately, Rocky, you've got Hong Kong coming in at 6%. Okay, so let's move on to the first theme, and it'd be interesting to see how people's voting patterns will change after we go through this panel discussion. So theme 1, regulatory developments and supervisory approaches. So Rocky, let's start with APAC. And I'm sorry to hear that Hong Kong scored last, but you did have Singapore at the top. So that's an interesting dichotomy in APAC. So are regulators in APAC countries merely focusing on implementing FATF recommendations? Are they focused on other risks that crypto assets and services propose?
Yeah, thanks, Monica. Yeah, I think first comment, Hong Kong, Singapore, I think it's I would put it as a more perception rather than a reality. The way I look at it in reality, it's quite similar. Obviously, as Monica put it before, each jurisdiction will have different regulatory regimes. So you do have to go to each specific jurisdiction to look at the actual regimes relevant. Hong Kong, Singapore, they do have different regimes, different concepts. The outcome, I would say, they do have largely similar themes, which I'll cover a little bit, and see whether that will change the audience perception after the session. Just looking at APAC more generally, it is correct. There have been quite a lot happening on the regulatory space on virtual asset, in particular driven by the FATF recommendation from an AML perspective, but also considering investor protection. So if we look at Singapore, for example, the MAS issued formal guidelines in January this year, basically setting out the expectations that certain virtual asset service providers, they should not promote their services to general public in Singapore. That highlights, okay, virtual assets don't touch retail. And then in April, Singapore then extended its oversight of virtual asset service operators to cover companies with Singapore local presence, but only offering services outside of Singapore. So they want to bring them into the regulatory regimes, and obviously having that FATF recommendation in mind. So they're extending the reach in terms of potential coverage. Now, looking into Hong Kong, now I would say there's even more developments. So both the HKMA, the banking regulator, and the SFC, the securities regulator, they have issued quite a lot of new rules, regimes, guidelines in a way to give a lot more clarity to the market as to how the regulatory regime will work. The MA, they issued a discussion paper on stablecoins, and basically they will look to regulate stablecoins, but consulting the industry on how and what stablecoins they're going to regulate in the first place. The MA, HMA, and SFC, they issued a joint circular in February, basically setting out the regulatory standards on how existing regulated intermediaries could provide virtual asset related services. So giving more clarity in terms of what's the standard required. And then in April, the MA issued a discussion paper on Hong Kong dollars. That's kind of the CBDC concept with the retail usage push and doing more consultation and try to push on that front. And then there's the new kind of getting the industry quite excited, a VASP licensing regime, a new licensing regime under the Anti-Money Laundering Ordinance. It's a new one, and it covers non-securities exchange operations. But it's still going to be regulated by the SFC, the securities regulator, so they have a dual role. So looking at Hong Kong, the common theme is there's also the theme in Hong Kong that you don't allow retail investors to have access to those VA operations that are regulated. And there are regulatory standards introduced. So not only from an AML perspective, but you have like capital requirements, selling practices, disclosure, with more of an investor protection in mind. So really, we do see Hong Kong, Singapore applying similar regulatory concepts, and of course, this same risk, same regulation it's a kind of the theme that regulators would run in both jurisdictions. And in terms of how existing financial intermediaries are reacting, we do see a lot of interest from traditional financial intermediaries, whether they're banks, asset managers. They are exploring, they're implementing, and they're going to the regulators and try to expand the service. They're currently going through the process actually right now in Hong Kong. And for existing new virtual asset operators, they're doing the structuring and planning for licensing application in Hong Kong. Some may decide to go elsewhere. Some decided to go for the license in Hong Kong for various different reasons under the new VASP licensing regime. So again, a lot have been happening, and given the time, I can't cover all APAC jurisdictions, but the general theme is hopefully give you a flavor as to kind of where the regulatory direction is going.
Thank you very much, Rocky. So that's very interesting, and I'm going to pick up later on, not now, on the new sort of licensing regime for non-securities exchange operations under the money laundering ordinance, because that's something sort of similar that we have in the UK, which Laura's going to talk about later, and it'd be interesting to understand so the comparison of experience in the two jurisdictions. Okay, let's move on to Ricardo. So I've mentioned in my intro, and we've heard a lot about the proposed EU attempt to harmonize and create a comprehensive regulatory framework through MiCA or MiCA. I'm not quite sure how to pronounce that, which one to use. But there are also other legislative measures. So can you run us through what is the now sort of the emerging EU level landscape for crypto regulation?
Yes, sure, and thank you for having us, from myself as well. Yeah, so I think I'll start by saying that, as you mentioned at inception, you always have to consider what is applicable rules in every jurisdiction where a particular instrument is offered and circulates. And in the EU is particularly true because the EU framework is two-layered. You have the EU legislation, which I'm going to talk about in a second. But then I would like just to remark that that's not the end of the story most of the time, because then you also have to consider local legislation at the level of each member state. And that is particularly true when there is no or little harmonization. And in particular, in the space of crypto asset, we are still at the point where there is little harmonization, but things are meant to change. There has been harmonization insofar as anti-money laundering regulations are concerned, even if it's not complete harmonization, but still crypto assets have been brought into scope by the 5th anti-money laundering directive. But other than that, the landscape is still not harmonized, but there are several initiatives. So in terms of the regulators approach, the first focus has been on looking how and whether crypto asset would be subject to existing regulations, and especially financial regulation. So initially, what the regulator has done is to consider whether, for example, crypto assets are financial instruments, and if they are then they subject to financial regulations, and how can existing financial regulation apply to assets that have a form that exists in a form that was not conceived at the time when financial regulation was issued. So this gave rise to issues like, is this token a security? How can it be traded? And in particular, for trading, this has led to one important initiative, which is referred to as the pilot regime, which some of you will be familiar with, which is basically an initiative aimed at creating a market infrastructure which is based on distributed ledger technology. And this is because today you cannot trade a digital asset on a trading venue, because in order to do that, you need your asset to be held with a central depository, and the technology underpinning digital assets does not lend itself to the asset being held with a central depository. So the pilot regime is supposed to change that, even if, in my opinion, I have to say, it doesn't really embrace in full the philosophy behind the decentralized and distributed ledger technology. But anyway, that's the intention. And then after that, the following logical step in the regulatory approach has been to consider how to treat those assets which do not fall under the existing financial regulation. And there is where the new MiCA regulation comes in. And I'm glad to hear that no one really knows how to pronounce it. Not myself, not being a native speaker, I'm always in doubt, but happy to hear that I'm not the only one. Anyway, so why? And by the way, probably because the approach has been to see how to treat assets that were not captured by financial regulation, probably because this is where regulator is coming from. That's why the framework that is being designed for crypto assets that are not financial instruments looks very much like the framework for financial instruments. So it's like a sort of replica of the existing financial regulation, but for crypto assets that are not financial instruments. So the idea behind MiCA was to on the one hand, put an end to fragmentation, because as I said, in the lack of harmonization, every member state has started to introduce its own regulation, and that has caused fragmentation. So the idea behind MiCA is to put an end to fragmentation. And then secondly, the intention is also to provide more protections for users, for consumers of crypto assets, because in the absence of a framework, there is really no protection, and the recent crash is a clear evidence of that. So if I could bet all my money on the stock exchange, but if I do that, there are some checkpoints along the road that to try and stop me, or if not stop me, at least explain what I'm going to do if I understand the risks and whatever. But there's nothing of the sort for crypto assets so far, and you could really literally lose all your money in a matter of seconds by pressing a button. So the regulator is trying to introduce a framework which gives some sort of an order to this scenario. So what does the MiCA do? It introduces provisions for the issuance of digital assets, which basically means that if you issue a digital asset, you have to publish a white paper, which is sort of like a prospectus with certain minimum contents. Then there are other obligations for issuers. They have to be authorized. And when you provide services in relation to crypto asset, you have to follow certain conduct of business rules, again, similarly to what happens with financial instruments. One topic which is interesting, I'll touch on it briefly, which is covered by MiCA, but it has been, it changed the shape during the negotiation. So I haven't said, by the way, that MiCA has not been enacted yet, so it may still change. One topic that's been discussed, though, is environmental implications. And this is something that's probably become even more paramount going forward, because the sensitivity on environmental issues is growing, of course. So the point here is that certain types of crypto assets, not all of them, but some of them, depending on the technology they use, they consume a lot of energy. We don't have time. I'm conscious that I'm running out of time, so we don't have time to explain why they use so much energy. But basically, it's because to update the register, to win the right to update the register, you have to solve certain math problems. And to solve this math problem, you have to use a lot of computing power, which means huge servers, huge machinery equipment, which operates 24/7 and needs to be cooled and so forth. So that's a huge consumption of energy. The regulator is aware of that, and at some stage of the development of the regulation, what was done was to introduce a provision that goes as far as to say that crypto assets which consume a lot of energy, whose infrastructure consumes a lot of energy, can only operate at a small scale, and crypto services providers should not offer services relating to those assets, which would mean, incidentally, the death of Bitcoin, for one. So the position has been then revised. Now there is just some obligation for the crypto services provider to provide information as to the environmental implication of certain assets, and then there's a more holistic approach at energy consumption. So the EU regulation on ESG matters will also consider how to treat digital asset operations that consume a lot of energy. I'd say that's more or less the environment we are here in EU at the moment. So I think I'll hand it over to Monica again.
Thanks very much, Ricardo. I think if we have time later on, it would be interesting to go more into the substance. Clearly, there's pros for certainty on MiCAR, but the con is securities regulatory framework appropriate for crypto assets? Whether it's a prospectus directive like obligations on disclosures, liability for custodians, establishment rules for cross-border non-EU providers. Okay, so let's move on to the UK. Laura, how would you compare the UK diverging approach? Is the UK too slow, or is it just slow off the starting line?
Thanks, Monica. Yeah, so I mean, I think it's fair to say the UK has taken a measured approach to developing crypto asset specific regulation. I mean, at the moment, sort of the status quo in the UK is that crypto assets are not automatically regulated, and really, in the most part, you look to the pre-existing regulatory regimes to work out whether or not a crypto asset is substantively a financial instrument. So similar to what Ricardo was talking about in a sense for the EU, I think that's really sort of a similar position for the UK, at least at the moment. I'll come on to talk about what's on the horizon and where there might be crypto specific regulation coming down the track. But just to talk about sort of the position today, it is fair to say so crypto assets could fall within one or more of the existing sort of financial services regulatory frameworks, or in many cases they could be unregulated. But first, so regulated activities relating to crypto assets with characteristics akin to shares, debt securities, or other kind of financial instruments under the existing UK regime are very much regulated in the same way as traditional financial instruments. So the idea there, and there's FCA guidance that makes clear that what you need to do is look at the substantive characteristics of the crypto assets, not how they're marketed or labeled, or the fact that they're using different technology. Again, kind of thinking about the principle, sort of same risk, same regulation. The FCA in particular, sort of in its guidance, has sort of set out how that kind of assessment should be done. perhaps slightly unhelpfully, it also says that crypto assets might change categorization through their lifetime, which does make it difficult if you're issuing crypto assets to work out how they should be regulated. But if they do have characteristics such as, other financial instruments, then generally they're referred to as security tokens, and be looking at the existing financial framework for regulating those. And of course, second, I think it's worth mentioning stable coins and the e-money regulation. Now, issuing tokens that do qualify as e-money is again a regulated activity today, and essentially this will be capturing fiat-backed payment tokens. But of course, the e-money regime today is pretty sort of narrow in terms of looking at some of the kind of stablecoin models out there. And so certainly there are a lot of stable coins that we see today that don't actually fall within the e-money kind of bucket. And therefore, sort of looking to the future, the UK Treasury has been consulting on plans to expand the regulatory perimeter to bring other kinds of stable coins within scope of regulation. And it's been focusing primarily on other kinds of asset-backed stablecoins rather than algorithmic stablecoins. But we saw earlier this year in April, the Treasury sort of put out its response to that consultation, confirming its intention to expand the regulatory perimeter in this way, and would also bring in sort of services, including custody relating to stablecoins as new regulated services. So that's sort of one kind of change on the horizon. It's fair to say that we're expecting sort of more consultations on that, and sort of timing is, hopefully later this year we will see something. And I'd say we're really looking forward to seeing that legislation published, as as you said, Monica, it will then give industry players really the certainty they need to plan and develop business in the UK. Although actually sort of, to say something perhaps quite positive about the UK, actually from a legal perspective, sort of straying away from the regulatory world, thinking about, what are crypto assets from a legal perspective? Do they qualify as property? If they're stolen, what are your remedies? Actually, the UK courts there have been quite crypto friendly, and there's sort of judicial sort of guidance and also some cases indicating that crypto assets of various types are or may be treated as property, and sort of have granted remedies accordingly. So I'd say that's quite a positive thing from a UK perspective in terms of giving legal certainty, even if we're still waiting for regulatory certainty in a number of areas. I think from the UK perspective, probably the other sort of main areas of development I just wanted to flag are first, financial promotions. So advertising, promoting crypto assets, that's another area where HM Treasury is planning to expand the scope of UK regulation to restrict financial promotions in currently unregulated crypto assets. And it's fair to say there are some sort of niggles or issues to work through there. Because at the moment, sort of the way financial promotions regime works is that you can only make financial promotions if you're an authorized person under the Financial Services and Markets Act, or if you fall then within some kind of an exemption, or you get your financial promotion approved by an authorized person. But what we have for crypto service providers at the moment is not an authorization regime, but a registration regime under the money laundering regulations. And again, that's sort of following the International Financial Action Task Force guidance. So putting crypto asset exchanges and custodians within AML regulation. So that's only registration, not authorization. So I think there's a question there how that fits in with the plan to expand the financial promotions regime, and will those registered firms actually be able to advertise, promote their services? And perhaps then just sticking just sort of the final point on the UK side with sort of AML type regulation, and this is a current regulatory development that we've really just seen sort of in the last month, some new rules published in draft, and that's around the introduction of the travel rule to crypto asset transfers. And the travel rule is something that currently relates or applies to payments made by wire transfer, so electronic payments. And in the UK, it's implemented under the UK money laundering regs and the onshore wire transfer regulation. Again, it comes from International Financial Action Task Force recommendations, and the recommendation at international level was to expand the scope of this travel rule to crypto asset transfers that exceed sort of 1,000 euros here in value. And broadly speaking, what it does is it requires today payment service providers, later crypto asset service providers, to send information identifying the payer and payee or beneficiary of transfers when making payments or crypto asset transfers, as I say, sort of electronic payments today. And I think there are a number of sort of conceptual challenges with expanding this kind of information requirement from electronic payments to crypto assets. And that's something that the Treasury has grappled with in a consultation already. Actually, just earlier this month, we saw its, as I say, its response to consultation and some proposed rules in a statutory instrument. And Treasury does say that it has taken on board some industry feedback, particularly around unhosted wallets, looking at what do you do if you're on the receiving end of a crypto asset transfer without the necessary information. You can't actually technically sort of refuse to take it. It's not the way that DLT blockchain works. And so, there are some issues there to work through, particularly around kind of practical implementation challenges. There is some time to do that, so new rules are expected to apply from the 1st of September 2023, but I think that's one that's going to be occupying a number of crypto asset firms over the coming months.
Thank you very much, Laura, for that comprehensive sort of overview of the UK regulatory framework. Okay, so turning to the US, David. So, the US SEC's hostility to crypto assets is well documented and reported. So what is the basis of this view?
Yeah, sure. It's funny. I think that people on the poll got it kind of right with the U.S., where 10% said that they were striking the right balance. That's certainly the feeling with many of our clients as well. I think that the news out of the U.S. is kind of the old news, but applied to new products, in the sense that there continues to be just a real lack of clarity around exactly when a crypto asset is within the purview of the SEC, within the purview of the CFTC, or essentially really kind of unregulated, at least at the federal level. And so what we're seeing now, though, is we have got an aggressive chairman of the SEC, Chairman Gary Gensler, who has really, I think, kind of thrown out the gauntlet and said, well, we think that pretty much everything is a security and should be regulated as such in the crypto space, other than Bitcoin. There were some statements even just, I want to say on Monday, where Chairman Gensler wouldn't even commit to say that ETH or Ethereum was not a security. So it's kind of an interesting time in the US, particularly because we have prior guidance from or prior statements out of the certain personnel at the SEC suggesting that Ethereum is not a security. But you also have this concept, kind of similar to what Laura was just talking about kind of the transient security. Something could be a security one day, but not a security the next day. And so again, it adds to that uncertainty. And I think what really makes our clients nervous is just the rapid expansion of the SEC's enforcement division with respect to digital assets. They recently doubled the size of their staff. They've also been pursuing cases against crypto lenders, which is somewhat new, and levying huge fines. I think BlockFi lending is one of the more recent ones, where you had a $100 million settlement with the SEC over a retail lending product that BlockFi had put out, and you've seen it in other contexts as well as including BitConnect. I think DeFi is the other area where the SEC has been really, really aggressive. I want to say towards about this time last year, so August of 2021, the SEC went after Blockchain Credit Partners. There's a $13 million settlement there, and I think that what kind of shook DeFi was the fact that there was specific mention. There were two specific types of tokens. One were the governance tokens that were sold, and there were other types of tokens as well that didn't give someone control over the blockchain necessarily, the ability to vote. But the SEC characterized both sets of tokens, including the governance tokens, as securities. And I think that there was a thought in the DeFi space that maybe those governance tokens were outside of the SEC's purview, but the SEC's clearly staked out a claim that that no, in fact, they are not. I think the other thing we're seeing here a lot more is sort of actions by state regulators. Again, in the crypto lending space, there was a little bit of buzz, I want to say at the end of last year, about the New York Attorney General sending out letters to Nexo, Celsius, and a couple other what I'll call crypto lending platforms, or platforms primarily based around crypto lending. The interesting thing about Nexo is that they're not US based. So again, US regulators are taking a position that whether you're in the US or outside the US, if you have any US persons on your platform, we effectively have jurisdiction over you, and we're going to view many crypto assets, and if not the bulk of crypto assets, to be securities that US regulators can take action around. I think stable coins are another huge topic of conversation right now in the US, both at the end of last year and then coming into this year. There's a lot of debate over whether stable coins are just kind of disguised banks, essentially, and whether or not stablecoin issuers should be regulated as banks. I think that debate has intensified given the Terra Luna meltdown, so to speak. And I think that there's still a lot of focus on Tether and other major stable coins to see exactly what's going to happen with them in the current environment. And so I think that certainly the SEC has cited issues within the stablecoin market as a reason to potentially regulate stablecoins as securities as well. Finally, I thought it was really interesting that what Ricardo just brought up around the kind of ESG types of considerations and environmental or energy consumption considerations. I say that because I want to say that not even 2 years ago, ESG was kind of a topic, but not really in the Bitcoin space, in the crypto space, but it has really just emerged over the last few years and months, to the point where there was even a number of members of the U.S. House of Representatives on the legislative side sent a letter to the Environmental Protection Agency, or the EPA, stating, we want you, EPA, to look into these proof of work mining shops and really figure out if they are using dirty energy, if they are harming the environment, et cetera. There was pretty big backlash against that letter within the industry itself. Michael Saylor, a number of other big players in the industry, I think, did a pretty good job of dispelling some of the rumors or some of the allegations that were in the letter from those representatives. But at the same time, you still have states like New York that are instituting at least, I think, what you could call partial Bitcoin mining bans around proof of work and concerns over the use of dirty energy. So that's a really quick sort of summary of what's going on in the US, and I'm sure we'll talk about some other topics as well.
Thanks very much, David. Okay, let's move on to the second theme, which is on the legal and regulatory framework for launching new crypto products. So, Ricardo, does the nature of the token actually matter?
Yes, I would say that that's probably the key question that one should ask himself when deciding to issue a digital asset, because depending on the answer, different rules would apply. And I'd say the key question, the main question is, first of all, to establish whether your digital asset is a security. Because, as we said before, if it is a security, then it's subject to the entire financial regulation framework. And so you have to do anything that you would do with a normal security, which is not in the form of a digital asset. In the EU, we don't have a principle-based definition of security. So the definition of what is a security is basically to be inferred by the list of instruments that are classified as securities for the purposes of the EU regulatory framework. So you have this list, which includes shares and bonds and other debt securities. And basically, so you have to ask yourself, is my asset, my digital asset, similar? Does it work? Does it entail the same dynamics as a bond, as a share, as another debt security? If so, then it's likely that your asset is a security. So in principle, if your digital asset incorporates a claim against the issuer, which promises a financial return, even if that return is linked to the success of a particular project, then in that case is very likely that your asset is a security. And at that point, you are subject to, say, traditional financial regulation. If it is not a security, then that's where the MiCAR comes in, because at that point you have an asset which most likely will fall to be governed by the markets in crypto asset regulation when it is issued. And so for that purposes, your asset will fall within the scope if it falls within the definition of crypto asset for the purposes of MiCAR, which means a digital representation of value or right based on cryptography, which takes the form of a coin or a token, and which is capable of being transferred and stored digitally with a type of technology which is the distributed ledger technology. So, and what I just said basically covers 99.9% of digital assets. So if you are in that situation, you are covered by MiCAR. Then within MiCAR, there are other distinctions to be made, because what I've just described is, say, generic tokens, which are subject to certain obligations, including, as we said, the obligation to publish a white paper, which is akin to a prospectus. And then there are conduct of business rules around how to provide services relating to the token. But if your asset is one particular type of token, i.e. a stable coin, then there are additional rules that apply. And within stable coins, you have a further distinction between, say, general stable coins and more specifically stable coins which work as e-money. If your token is intended to work as electronic money, then it is treated as electronic money and will fall under the regulations covering e-money. One type of asset which I'd like to mention, which is in principle not covered by MiCAR, is NFTs. So they have become popular, probably not so popular today. It used to be, maybe gain popularity again. Anyway, non-fungible tokens, they are not in principle captured under MiCAR because they are not fungible. They are not considered as part, they are carved out. Although one should also bear in mind that if a non-fungible token looks like a security, meaning it incorporates a right against the issuer and so forth, then it may still be treated not as a crypto asset for MiCAR, but it may well fall under the framework of, say, traditional financial regulation. One last thing is, as I said also before, again, we have two layers of legislation in the EU. So when considering issuing a digital asset, you also have to look at local legislation, especially now that the MiCAR is not in force yet. So you have different regimes in different member states. And in those cases, even if your token is not a security for the purposes of the EU framework, it may still be treated as some form of financial product for the purposes of local legislation. And for that purposes, it may be that you have to apply certain tests that are more based on principle, and as the outcome of that test, it may be that your token is subject to some form of financial regulation in one specific jurisdiction within the EU. That depending on tests that may be principle-based tests, and I suspect it's more similar to what happens in the US that they will tell us about in a minute, I believe. But I'll hand it over to Monica now.
Great. So let's move to David. So how do we contrast that approach with the SEC approach to token classification, David?
Yeah, I think that Ricardo got it exactly right. Like in the U.S., it's a principle-based test. There's no sort of there aren't hard and fast rules, despite the fact that the industry has really been pushing for those for a very long time. In the US, the primary test is something known as the Howie test. Essentially, it examines a specific product to see if there's been an investment of money in a common enterprise with an expectation of profit, where those profits would be derived from the efforts of others. So essentially what the SEC is trying to figure out is, does your product look like the shares of a corporation where you are making a passive contribution of money, and individuals, whether it be executives, software designers, whomever, is then taking that money, building a platform, and then deploying that platform with the expectation that you as the your investment as the investor, the tokens that you receive in exchange for ETH or Bitcoin or whatever, will appreciate over time. And so with that lens, I think the SEC has really been able to take the position that really most crypto, at least in its view, most crypto assets are in fact securities. And there's a fair amount of judicial precedent in the United States defining the concept of a security quite broadly. So what Chairman Gensler and others have really tried to do is to say, well, all these crypto assets we're seeing running around, they look an awful lot to us like securities. So Coinbase, these other platforms, Kraken, other platforms that have more than maybe one or two, more than Bitcoin, frankly, on their platform, may in fact need to be registered in the US as securities exchanges or as alternative trading systems, et cetera. I think the other thing to point out is that once you get into the securities regulatory structure in the United States, that's often kind of like an existential threat to many crypto asset developers, because the requirements are just so robust. And there has not been, as far as reporting and as far as registering or finding an exemption under what we call the Securities Act of 1933. And then you have all the secondary actors, the broker-dealers, ATSs, that themselves are subject to really very heavy registration. And then on top of all that, even if you want to register with the SEC as an exchange, it has been made exceptionally difficult, because the SEC just doesn't really, at the end of the day, I think it comes down to the SEC just really doesn't trust the technology still. They don't trust the underlying blockchains like Ethereum for the long haul. And so they're not willing to risk on their watch, Chairman Gensler's watch, for example, some type of meltdown of the Ethereum blockchain that ultimately the SEC is somehow blamed for. So I think that there's still a lot of that going on, and really the only kind of guidance, and I put that in air quotes for a reason, that we've received from the SEC was back on like how to identify what an investment contract is or is not, other than enforcement actions, was something. It was an investment contract framework that came out in April of 2019. And if you read that framework, again, there's so many factors, so many considerations, and it's all facts and circumstances. So you could really, looking at that, come to the conclusion that just about any crypto asset is a security. So it just kind of continues this theme. There have been attempts in the US to introduce legislation that would try and help on the congressional level, that would try and help clarify things a little bit. I think the most recent one was proposed by Senators Loomis and Gillibrand. And in that proposal, it was interesting because more power, I think, more regulatory authority would be given to the CFTC in many circumstances than to the SEC. Needless to say, Chairman Gensler is not a fan of that proposal, and it's unclear if it's going to ultimately go anywhere. Just to pick up very quickly on the discussion about NFTs that Ricardo just noted, in the US, because we're kind of solely a principles-based analysis, again, it can be unclear whether or not an NFT is in fact a security. I think in many cases where you have one individual, for example, who buys an NFT and holds that NFT for themselves, something akin to artwork, I think there are very good arguments that is not a security. I think where the lines start to blur a little bit is where you have fractionalized interests in a particular NFT. For example, you have 5 or 6 people who pool their money together and then provide it to another person to then deploy that money, like you might see in a DAO, digital autonomous organization, that's trying to purchase something that's very expensive. It starts to look a lot more like a type of security or security type arrangement, or maybe even investment company. So there's still a lot of question around that here in the United States, and there have in fact been lawsuits. I think there's one right now against like some NBA top shots. There are questions around whether some of the NFTs that it issued or at least there have been allegations that some of the NFTs it issued were in fact securities. So again, there's always that. In addition to the regulatory side, you have the litigious nature of people in the U.S. That again increases the risk. But that's kind of a good survey, and I'll turn it back over to you, Monica.
Thanks so much, David. It is a real challenge. I'm not sure how anybody can do any product launches
as lawyers, I guess it's good for us in some ways because people are coming to us and asking questions, but then at the same time, you don't really know sometimes what to tell certain clients. You can only advise them on how to mitigate the risk. But anyway, sorry, I'll hand it back over to you.
No, thank you very much. Okay, so turning to the last theme, we're now going to focus on the legal and regulatory considerations for the service providers. So focusing on crypto custody, crypto exchanges, and prime brokers. So Laura, for the last 18 months, there's been significant FCA activity around registering crypto asset service providers. So what legal and regulatory issues do service providers need to grapple with at this stage?
Yeah, so, and I think, we've seen the UK take quite a rigorous approach in this space. But sort of stepping back a little bit in terms of, the rationale for these rules applying to crypto service providers, particularly custodians and exchanges, I think it's fair to say that, these service providers are in some way seen as gatekeepers to the crypto world. And so they are therefore the firms on which, initial AML sort of regulation has been placed. And that kind of follows again international guidance. But in the UK, as you said, so crypto firms that are custodians or exchanges needed to register with the FCA in the UK. And the rules came into play in January 2020, but there was a kind of a temporary registration regime for existing firms. And we saw that temporary registration period end in March of this year. And actually the FCA we saw applied a really high standard to the registrations, and they approved really actually just only over 30 firms, 30 something firms, and rejected kind of 80% of the applications that it got according to sort of FCA figures. And I think that the sort of the rationale for that from the FCA's perspective was actually that a lot of applicants just didn't meet the FCA's expectations and standards around the AML KYC procedures that they expected firms to have in place. So the FCA is certainly, applying a high bar around that and around crypto custody, around exchanges. And in practice, then I think we saw a lot of firms having to close down their UK business, often at very short notice, giving rise to some pretty tricky legal and regulatory issues to navigate to sort of make sure that they weren't carrying on kind of regulated business when they no longer had that registration to do so. Of course, that's sort of the AML registration. As I mentioned, we're also expecting to see an expansion of the kind of the authorization regime for certain crypto custodians, particularly relating to stable coins in the near future. And so again, I think, it remains to be seen kind of what approach the FCA takes to, future authorization applications. Again, will it's kind of set a really rigorous approach. I think there's an interesting kind of dynamic between the Treasury and the FCA. So the Treasury sort of saying, we want the UK to be a global crypto hub, whilst the FCA is then issuing these kind of risk warnings and kind of setting these high bars around crypto asset service providers. And I think, just one other point, and actually this is an EU point for crypto custody, which I think has caused a lot of concern in the market, particularly around sort of institutional clients trying to explore getting into crypto and crypto custody, is actually under the MiCA regulation, MiCA. So actually there are really tough new standards in that regulation around custodian liability for loss of crypto assets, which take inspiration really from depository rules under EU funds regulation. But that's sort of, going beyond even what we see in MiFID sort of traditional financial instruments custody. So that's sort of a real point where crypto custodians or kind of firms looking at crypto custody need to assess, what's their risk appetite around that. And a very brief point maybe on crypto exchanges, I think that the kind of a lot of what we're seeing there is very much about how to navigate regulatory regimes globally. And sort of structure exchanges in ways that ensure, you can face your local customers, you have the right licenses, but how do you marry together all of the different regimes we've been talking about? And so I think, that's where we've seen kind of a lot of, firms asking questions, actually also in the EU, seeing if they can set up an EU entity to try and benefit from grandfathering under MiCA. So I think there's a lot of activity going on there in the crypto exchange space, sort of positioning for some of these new regulations coming through in the coming months and years.
Thank you very much, Laura. And I do think that there is a real challenge to square that circle where you have a Treasury HMT that's really pushing UK fintech, crypto services and marketplace, particularly in a post-Brexit environment, versus a very reluctant and suspicious regulator. So, Rocky, in Asia, and particularly Hong Kong, with the new sort of registration regime under the money laundering ordinance, anti-money laundering ordinances, how do you also see this sort of, I don't want to say schizophrenic, but you also see this sort of opposing and a contradictory approach between the legislative agenda, the governmental agenda, versus the regulatory approach for registering local crypto service providers?
Yeah, I think that's a very interesting point, because I think in a way I do see it, the interests are aligned as to what the government's trying to push and what the regulators are trying to push. The way I see it is the regulators are trying to be permissive. So at least from a Hong Kong perspective, they permit virtual asset operations, but they do set standards, and it's there for investor protection. At least at a start. I mean, we ought to have a starting place somewhere. It may be some marketplace may see that as relatively high, but of course it's as long as we get a clear and workable regime. Obviously, that's the ultimate aim. Then I think that is a very good starting place. But obviously, we need the right combination. So that's why the government's pushing, getting reputation, getting the speed to implementation, and obviously resources for regulators, all in place for the overall kind of basically regulatory ecosystem to work. And it's not just for Hong Kong, for everything, everywhere else, and it's a global theme as well in terms of how I see a successful kind of virtual asset regulatory framework development would look like for any particular jurisdiction.
Sorry, thank you. Okay, so we are coming to the end of the panel session, and we do have a few questions. I mean, we have a couple of minutes left, so we do have time for one or two questions. So we touched on very briefly Terra and Luna, but it may be worthwhile just to summarize across the four regions. What has the impact of the collapse been in terms of regulatory approach and attitude? So why don't I start with David? You mentioned the SEC sort of approach, but great to hear you summarize the position.
Yeah, I think that, right after the Terra Luna collapse, Chairman Gensler was giving testimony, I believe, before a congressional committee, and he specifically noted the collapse and the wiping out of, I think he said $4 trillion or so, or $4 billion or so dollars, as a very precise reason why there needed to be more regulation in the space, and just express a lot of concern over retail. So retail investors, I do think that it's created a shift in mindset, at least in the United States, that I think could be accelerated if Tether or some other stable coins start get into distress. We're not seeing that yet. There are reports of hedge funds and others shorting various stable coins in an attempt to kind of cause or maybe have the same type of effect as what we saw in Terra Luna. over time, but I think it remains to see. But if we do see a failure of another stablecoin, it could galvanize action in Congress here in the United States, or certainly by regulators much more quickly.
Thanks. And last word, Rocky, I'm going to give you the last word of the day. How do you think regulators in Hong Kong and Asia are dealing with Terra Luna?
Yeah, that's actually quite interesting topic, because I mentioned the HMA discussion paper around stablecoin. Actually, in the paper, it suggested non-fiat backed algo-based stablecoin. It may not be the top priority of regulators in the first instance from a regulatory perspective. But given what happened to Terra, it will be very interesting to see how the regulator reacts in terms of formulating their regulatory regime over stablecoins.
Okay, so thank you very much, panel. It was a really interesting discussion, and very pleased to hear your insights. And thank you to the audience. And for those that ask questions, we've got them in the questions panel. We will respond to you. So thank you very much, and have a great day.
Thank you.
Thank you.